Friday, January 30th, 2026. If you are listening to this, just take a breath.
Seriously, take a deep breath.
Yeah, you probably need it. You survived. Or maybe you didn't.
Well, that's the thing, isn't it? Maybe your portfolio is looking a little bit like a crime scene right now.
Crime scene's a good way to put it. But we need to sit down. We need to talk about what just happened. Because if you looked at a price chart for precious metals in the last 24 hours, you probably felt like the world was actually ending.
It wasn't just a feeling, though. For a few hours there, I mean, mathematically speaking, it was absolute carnage. It was a structural break in reality.
I mean, let's just set the scene here because I don't want to gloss over the trauma of this. We have to acknowledge the date. This is going to be one of those days people remember, January 30th.
Oh, yeah. This one goes in the history books.
Just 24 hours ago, on Thursday the 29th, we were popping champagne.
Euphoria was at its peak. Absolute peak.
It was a party. I mean, silver was at highs of $121. Gold was sitting pretty at $5,600. It felt like the train had left the station.
The dollar was toast, yep.
And we were all just enjoying the ride to the moon.
Yeah.
And then Friday morning hits.
And the floor didn't just drop out. It vanished. It just dissolved into nothing.
It was apocalyptic. In a single trading session, and I have to stress that not a week, not a month, a single session, we watched silver dive from those heavens straight down to $73 an ounce.
Just a straight line down.
Gold collapsed to $4,690. I was watching the 1-minute chart, and I have to tell you, it looked like a total liquidation event. It looked like the asset class was going to zero.
And you know what? It was designed to look exactly like that. That is the key here. This wasn't accidental chaos. It was, let's say, engineered chaos.
And here is the twist that we're going to spend this entire deep dive unpacking.
Yeah.
It didn't stay down.
No. It snapped back. Violently.
It was like a rubber band that got stretched until it almost snapped. And then it ripped back up. This is what you call a reversal trap, right?
That's exactly right. And to understand what happened today, we have to stop thinking like normal investors. I mean, if you look at this through the lens of news headlines, oh, did the Fed say something? Did a war start? None of it makes sense.
You'll be chasing ghosts.
Exactly. You'll drive yourself crazy. There was no news that justifies a 40% drop and a massive recovery in 6 hours. It doesn't exist.
So what is our mission today? Because I feel like I need a stiff drink just recounting those numbers. And I suspect our listeners do too.
Our mission today is to conduct what we're going to call a red team intelligence briefing. We are going to step out of our own shoes, the shoes of the retail investor or the long-term holder, and we're going to step into the shoes of a high-frequency trader, an HFT.
Okay, so we're becoming the predator for the next hour. We're thinking like the shark.
Precisely. We are not looking at fundamentals. We don't care about silver's use in solar panels today. We are looking at market structure, liquidity, and predation. The core question we need to answer is this. Was Friday a market crash, or was it a calculated stop run?
I want to pause on that red team concept for a second, because when you say smart money or HFT, it sounds almost conspiratorial,
It does, yeah.
Are we saying there's a guy in a dark room pushing a button to crash the market? Or is this something more systemic?
It's less about a villain in a dark room twirling a mustache, and it's more about just the raw nature of liquidity provision in modern markets. Yeah. But I mean, let's be honest, it feels predatory. When you look at the chart, it looks like a hunt.
That's exactly what it looks like. It looks like something was being hunted.
That's because it is a hunt.
Yeah.
But they aren't hunting people, they are hunting orders. You have to strip the morality out of it just for a second to understand the mechanics.
Okay.
If you are a high-frequency trading algorithm, you have one mandate, execute trades efficiently, that's it.
And to execute a massive buy order efficiently, you need someone to sell to you. A lot of someone.
Precisely. And where do you find the most sellers all at once?
Where everyone is panicking. Where the blood is in the water.
Or, mechanically speaking, where the stop losses are clustered together.
And that is what we are going to dissect today. We're going to talk about the psychology of panic, the mechanics of this thing called the hammer candle, and we are going to do the math on the brutal, lethal difference between holding leverage and holding the physical metal.
That distinction, leverage versus physical, that really seems to be the difference between financial life and death on a day like today.
It is the difference between being completely wiped out, account to zero, and just having a very stressful afternoon.
Okay, let's unpack this. Let's start with the crime scene, as you called it. We need to look at the anatomy of the flush. Walk me through the drop itself. What did that look like mechanically?
You have to visualize the violence of the move.
Yeah.
We are not talking about a slow bleed where silver drifted down over a week.
No, this wasn't a gentle slide. Not at all. We are talking about a vertical red line from $121 down to $73.
It's the terrifying speed, isn't it? The sheer velocity of it.
Think of it like a submarine. Imagine silver is this advanced, powerful vessel. For weeks, it's been cruising near the surface, and then Friday morning, something goes wrong, a hatch blows, it dives.
It just nosedives.
Straight down, it's diving deep into the abyss, pressure building every second, alarms blaring, the hull creaking, just screaming towards the ocean floor, and it hits the bedrock at exactly $73.
And that impact creates a shockwave.
A massive shockwave. But here's the important part. Because it hit bedrock, it didn't disintegrate, it bounced. It literally rocketed back towards the surface. But we have to ask the critical question, why $73?
Right. It's not a random number. Why not 70? Why not 65? Why did the submarine hit the floor exactly at 73?
Okay, so to understand $73, you have to pull up a longer-term chart. You have to go back to the volume profile of the previous cycle, specifically looking at late 2024 and early 2025.
You're talking about where the most volume was traded historically? Like where the most shares, or ounces in this case, changed hands?
Exactly. Think of price history like a topographical map of a battlefield. Most of it is just empty fields. But some places have trenches, bunkers, fortresses. $73 was a fortress in the last cycle.
So it was a major point of contention before.
A massive one. It's what technical analysts call a high-volume node. Millions and millions of ounces changed hands right around that price level previously. It was a point of equilibrium.
So the market has a memory, or the algorithms do.
The algorithms have a perfect memory. They know that at $73, there is a massive wall of limit buy orders that have just been sitting there, effectively collecting dust, waiting for the price to come back to them.
It's like a safety net that's been laid out months in advance.
It is. When the price is crashing, it's like a knife falling through air. But eventually, it hits the granite countertop. That countertop was the volume node at 73.
And that explains the confluence you mentioned in the notes. It's not just one thing. It's multiple things pointing to the same spot.
Right. It's a confluence of factors.
Yeah.
You had the historical support from that volume node. You likely had a major long-term moving average, like the 200-week, sitting right around there. And you had the psychological breaking point, when 3 or 4 independent mathematical models all point to the same price.
The algorithms see that as a high probability zone.
They treat it as a hard floor. It's not a guess, it's a calculation. They knew where the buyers would show up.
So the market, or the smart money, at least knew 73 was the number before we even opened the trading session.
I would bet my last dollar on it. They knew. The algorithms knew. And that brings us to the liquidation event. You mentioned that apocalyptic feeling earlier. That feeling is actually a mechanism. It's called the margin call.
Ah, the dreaded call. The most painful part of trading. Explain how that works in a cascade like this.
Okay, so when silver starts dropping that dollars per minute, anyone who borrowed money to buy silver, so anyone using leverage,
Which is a lot of people in the futures market.
a huge number of people, they're all getting an alert from their broker. It's a notification that says, your account is in trouble, deposit more cash right now, or we will sell your position.
But when it's dropping $10 in a minute,
There's no time. You can't deposit cash. You can't wire money fast enough. Your bank isn't even open. So the broker doesn't wait for you. The broker's risk management software just sells.
they force liquidate you. They hit the market sell button for you.
For you and against you. Exactly. So you get a cascade. The price drops a little, which triggers the first wave of margin calls. The brokers sell those positions, which adds more selling pressure, which drives the price down further.
Which then triggers the next wave of margin calls for the people who are a little safer.
Exactly. It's a feedback loop from hell. It's a self-feeding fire. By the time the price hit $73, we reached a state of what we call exhaustion.
Exhaustion meaning,
Yeah.
just what it sounds like, there was no one left to sell.
Literally no one left. Every single trader on margin had been wiped out. Every retail trader who was terrified and had a stop loss had been triggered. The bulls who were celebrating on Thursday posting rocket ship emojis.
They were puking their positions on Friday.
It's a visceral term, but it's accurate. They were forced to liquidate at the absolute worst possible moment, at the lowest possible price. It's the point of maximum pain.
It's the point of maximum capitulation.
And that is exactly where the selling pressure vanished. It just
Mhm.
evaporated, not because people suddenly became bullish again, but because there was literally no one left who could sell. The sellers were gone.
That is a chilling thought. The market literally shook the tree until the very last week leaf fell off.
And that is where the red team perspective comes in. This is where it gets really interesting and, honestly, a little dark.
Okay, let's go there. We've been teasing this HFT perspective. You said we need to think like a high-frequency trader. So, okay, I'm an algorithm, I'm a predator.
Yeah.
What am I seeing when this is happening?
You're seeing pure, beautiful liquidity. You don't care about the industrial use of silver. You don't care about the dollar collapsing. You care about one thing and one thing only: order flow. The quote you have to burn into your brain is this one: "We saw the liquidity at $73. We went and got it."
We went and got it. That phrase implies intent. That implies this was not an accident.
It wasn't a crash based on news. I'll say it again. There was no news that justified a 40% drop in silver in a few hours. This was a liquidity grab.
How does it work?
Mhm.
Mechanically, I want to visualize the order book here. What's
Mm.
actually happening second by second?
Okay, imagine the order book is like a tall glass building. The current price is the elevator. Below the elevator, on every floor, you have bids, which are the buy orders, though the floor is holding the elevator up.
Okay, I'm picturing it. Layers of concrete holding the elevator up.
But scattered on those floors are, let's call them trapdoors. Those are the stop-loss triggers. They're hidden landmines. If the price hits one of those trapdoors, it doesn't just rest there. It triggers a market sell.
Which means sell at any price, I don't care, just get me out of this falling elevator.
Yes. So the HFT algorithm, it scans the building. It sees a whole cluster of these trapdoors just below $100 and another massive cluster below 90 and a huge one right above 75. So what does it do? It sells a little bit of silver, not a lot, just enough to push the price down to that first floor.
You just nudge it over the edge,
Yeah.
you tip the first domino.
Exactly. I push the elevator down one floor, those stops trigger, boom, trapdoor opens, they sell. That selling pressure now pushes the elevator down to the next cluster of trapdoors. More selling, you see? I don't have to sell my own stack anymore.
The retail traders are doing the work for you. Their panic is fueling the drop.
They're cascading the price down for me. It's beautiful in a brutal way. They're handing me the fuel to get to my destination.
And where does it end?
It ends at the trap. The entire move is designed to drive the price down through all that weak liquidity to the real prize. The massive limit buy orders waiting patiently at $73.
So while the retail guys are panic selling on the way down, someone else is just sitting there at the bottom of the elevator shaft with a giant bucket.
That is the perfect picture of accumulation versus panic. At $73, you had two very different participants. Retail was selling because they were scared. That's panic. Institutions were buying because they are prepared. That's accumulation.
I love the analogy of the vacuum cleaner here. It really paints a picture.
It's perfect, isn't it? Imagine a giant industrial-sized vacuum cleaner. It's labeled Smart Money, and it's just sitting there at $73. It's turned on, just humming, waiting. The algorithms drive the price down, shaking all the retail traders out of the tree, and this vacuum just sucks up every single cheap coin that falls.
They didn't chase the price up to 121 to buy.
Never.
They brought the price down to them.
They let the price come to them. It's efficient. It's ruthless. And it is a massive transfer of wealth from the impatient and the leveraged to the patient and the liquid.
It brings us to the psychology of the crash.
Mhm.
Because even if you know this, even if you understand the mechanics intellectually, when you see the vertical red line on your screen, your brain just screams at you.
It's biological. It's the fight or flight response kicking in. We call this the decision point. And you have to visualize the fork in the road that every single person faced today.
Okay, I'm picturing it. Two paths.
Path A is the panic path. It's the hand hovering over the big red sell button. Your account is down 20, 30, 40%. All you want is for the pain to stop. You just want to save what's left. This is your amygdala hijacking your logical brain.
And path B.
Path B is the opportunity path. It's the hand grabbing a stack of silver bars. It's the person who looks at that carnage and says, "Thank you. This is what I was waiting for."
There's that great quote from the briefing. Retail sees minus 20% and sells. We see minus 20% and buy.
That sums up the entire game. But think about the psychological pressure. When a chart goes vertical down, it looks like it's never going to stop. It
Uh,
feels like it's going to zero.
It feels like the asset is fundamentally broken. Like silver is now, I don't know, worthless all of a sudden.
And that feeling, that's what defines the capitulation low. It is the moment where fear peaks. And what's so fascinating is the divergence of emotion. The worse the chart looks to the average person, the scarier, the messier, the bloodier it is, the better the opportunity looks to the algorithm.
The algorithm doesn't feel fear. It has no emotions.
None. It just sees numbers. It sees that silver is now statistically wildly oversold. It sees that the price has hit a major structural support level. It sees the volume profile. It executes. While you are hyperventilating and sweating, the machine is calmly buying everything you're selling.
So selling into this volatility is exactly what the algorithms want you to do. You are literally feeding them.
You are providing the liquidity they need to fill their buy orders. They can't buy millions of ounces at $73 unless someone is willing to sell millions of ounces at $73.
And the only people willing to sell at 73 are the ones who are forced to because of margin or the ones who are absolutely terrified.
Precisely. And the algorithm preys on both.
Let's move to the evidence that this was a trap, because some people might still think, well, maybe it was just a bad day.
Yeah.
We mentioned the hammer candle earlier. Now, I'm not a technical analysis wizard, so walk me through a forensic autopsy of this chart. Why is this candle so important?
Okay, so for anyone who doesn't stare at charts all day, a candle on a price chart just shows you 4 key pieces of data for a time period. The open price, the high, the low, and the close.
Got it. It's a snapshot of the day's trading.
Right. Today's candle is what we call a hammer. It has a very small body at the top. That's the small range between where the price opened and where it closed, and a very, very long line extending down from it.
That line is called the wick, or the tail.
Right. Now, what does that wick represent? This is the key. It represents the rejection of lower prices. It is the visual proof of a massive battle that took place.
So the very bottom of that long wick is that $73 mark we keep talking about.
Yes. The wick shows us, it proves, that the price went all the way down to 73. The bears, the sellers, they tried to kill it. They pushed it as deep as they possibly could. But then massive buyers stepped in at 73. The pressure completely reversed, and the price was pushed all the way back up to close the day near $85.
So the wick is essentially a scar on the chart. It shows where the price was but couldn't stay.
It shows that the bears failed. They gave it their best shot, and they failed spectacularly. In technical analysis, a long wick at the bottom like that is considered one of the most bullish signals you can possibly get. It proves that the market found a hard floor. It proves there is massive, voracious demand down there.
This goes back to that beach ball analogy you mentioned.
It's a perfect physical representation of what happened. Think about holding a beach ball underwater at the pool. The deeper you push it, the more pressure builds up, right? It wants to surface.
And the sellers are the hand pushing it down.
Exactly. They are applying all this downward force. But eventually the hand gets tired, the sellers become exhausted, which is what we talked about earlier. And when that pressure is released, when the hand finally slips, the ball doesn't just float up gently.
No, it snaps back. It launches out of the water.
It rockets. It breaks the surface with incredible force. That explains the move from 73 back up to 85 by the close. It was the violent release of all that stored potential energy.
And that energy was different for gold and silver. This brings us to the torque effect, the tale of two metals, because they didn't behave the same way.
Not at all. I mean, if you were holding gold today, you had a bad day. If you were holding silver, you had a heart attack.
Gold dropped to 4,690, and it bounced back to 4,895.
That's a big move for gold, for sure, but it felt, I don't know, steady, contained.
It was solid. Gold is the bedrock of the system, but silver dropped to 73 and ripped all the way back to 85. It was pure violence.
Gold on steroids.
That is the torque effect. You have to remember, silver is a much, much smaller market than gold. It's thinner, there's less liquidity overall. It takes far less money to move the price of silver significantly, both up and down.
So when the whole market crashes.
Silver crashes harder. It has a higher beta for the technical folks. It's just way more volatile.
But when the market turns on a dime like it did today.
Silver runs faster. It has more torque.
I really like the vehicle analogy here. Gold is the tank.
Gold is absolutely the tank. It's heavy, it's armored, it can drive through walls, but it moves at a steady, predictable pace. It's unstoppable in the long run, but it's not flashy. Its job is to protect you.
And silver. Silver is the souped-up sports car. It's a Ferrari with bald tires on a wet road. It spins out on the curves. There's smoke everywhere. It looks dangerous as hell. It's exciting, but it can kill you if you don't know how to handle it.
But when it finds traction,
It accelerates from 0 to 60 instantly. It leaves the tank in the dust on the straightaways.
and that's what we saw today at the $73 level, it found traction.
The signal here is crucial. The fact that silver reclaimed $12 in a single session, from the low of 73 to the close of 85, that is a massive, massive signal.
How so? What does that tell you versus a smaller bounce?
A dead cat bounce, which is what you call a fake recovery in a bear market that usually drifts lower. You hit the floor, you bounce a little bit, maybe 5%, and then you just roll over and die. You make a new low the next day.
Right. It's a weak, unconvincing bounce.
But a real structural reversal, that snaps back with violence. The violence of the recovery has to match the violence of the crash. It's Newton's third law for markets.
So the fact that it was so aggressive on the way up confirms that the bottom might actually be real, that it wasn't just a flicker.
It confirms that the buyers at $73 were aggressive. They weren't just nibbling, they were feasting. They were trying to buy everything in sight.
Now, we absolutely need to issue a warning here, because while the smart money feasted, a lot of people got slaughtered. We need to talk about leverage versus physical. You call this a mortality event.
The quote from the briefing is stark, and everyone needs to hear this. If you were 5x long, you died today. If you were 1x long, physical, you just had a volatile Friday. Know the difference.
I want to run the math on this mortality event, because a lot of people hear 5x leverage and they think, hey, that's not that crazy. It sounds reasonable compared to the 100x leverage you see in crypto.
It feels safe until the one day it isn't, and today was that day. So let's do the math. Suppose you have $10,000 in your trading account. You're feeling bullish, so you go 5x long on silver. That means you now control $50,000 worth of silver.
Okay, $50,000 position, $10,000 is my own money, $40,000 is borrowed from the broker.
Right. Silver dropped roughly 40% from the high to the low today. What is 40% of your $50,000 position?
That's a $20,000 loss.
But you only had $10,000 in your account to begin with.
So I'm not just wiped out. I'm not just at zero. I owe the broker money.
Well, the broker's computer won't even let it get that far. The second your account equity hit zero, actually, well before that, usually when you dip below 50% of your required margin, their computer system auto-liquidated you. It sold your entire position at the market. You were sold out at the bottom.
So even though the price bounced all the way back to 85, where I would have been safe if I had just held on.
You're already gone. You were washed out at the mathematical breaking point. Your chips are off the table. That is the leverage trap. You don't get to participate in the recovery.
It's the journey that kills you, not the destination.
That is the perfect way to say it. Even if you were 100% right about the ultimate direction, that silver was going up, you were liquidated by the volatility before the bounce. You lost.
But the physical holder, what about the guy with the monster box of silver eagles in his safe?
He survived the stress test. He probably looked at the price on his phone, swore a little bit, maybe sweated for an hour. But he didn't sell. Why? Because no one could force him to sell. There is no margin call on physical metal sitting in your possession.
His thesis is completely intact.
He still owns the exact same number of ounces he did yesterday, and by the end of the day, the paper price was back up to 85. He just had a volatile Friday. He did nothing, and by doing nothing, he won.
So the lesson is, high volatility markets like this are specifically designed to wash out leverage.
They hunt leverage. Leverage is the prey. It's the slow gazelle at the back of the herd.
Don't short the hole. That's another phrase that came up in the briefing. Explain that one.
Yeah, so imagine the guy who missed the initial drop. He wakes up, sees silver has crashed to 75, and he thinks, wow, the trend is down. It's going to zero. I'm going to bet against it. So he shorts at 75.
And then it rips $12 straight up in his face to 85.
He's dead too. He got run over by the sports car reversing at full speed. He shorted directly into the strongest structural support on the entire chart.
But at the same time, chasing the breakout at 85 is also risky, right? You don't want to get caught up in the euphoria of the bounce.
Exactly. You don't want to buy immediately after a 15 or 20% vertical move up. That's called chasing. You are buying someone else's exit. You have to be patient and wait for the dust to settle.
So what comes next? This brings us to the roadmap. Because everyone listening wants to know, is the low end, are we going straight back to 120? What happens on Monday?
Okay, first things first, We need to manage expectations. This is what we call the rebuilding phase. Do not expect a straight line back to $150 immediately. That's not how markets work after a traumatic event.
The market is wounded. It's traumatized.
It is. It's like a patient recovering from a massive surgery. It needs time to stabilize. Expect chop, expect volatility. We are going to see wild swings in both directions as the market tries to find a new equilibrium, a new fair price.
What are the key levels we need to watch? Give me the numbers that matter now.
Okay, get a pen, write these down. First, the floor. The zone between $75 and $80. The market needs to hold above this zone. If we retest 75 and it holds strong, the bottom is confirmed. It proves that 73 was the absolute final low.
Okay, so 75 to 80 is the new floor. What about the immediate ceiling?
The test is the zone between $86 and $88. This is the immediate resistance. We need to break above this area and hold above it to prove that the crash was just a flush and not the start of a new downtrend. If we get rejected hard there, we might roll over and retest the lows.
And the green light. When do we know we are fully back in business and the bull market is back on?
$95. If silver reclaims 95, the bearish narrative is completely deleted. It's gone. It's invalidated. At that point, we are back in price discovery mode, looking for new highs.
So $95 is the magic number to restart the party.
That's the gateway back to the bull run.
So let's put it all together. What's the verdict? Is this a dead cat bounce, or is the low end for good?
The smart money verdict, based on the price action we saw today, is this. The market tried to break silver. It threw everything it had at it. It triggered every stop loss it could find. It liquidated every single margin trader, and it failed.
The submarine hit the bedrock and bounced.
The submarine bounced. The dip was a gift for the liquid and a complete nightmare for the leveraged. That's the final verdict.
Before we close out, I want to pose a question, sort of an ethical dilemma. We talked about the red team. We talked about algorithms hunting stop losses. Is that fair? Is that ethical?
It's a valid question, and it's one people struggle with. Is it ethical for market makers to push prices down with the sole intention of triggering stop losses? They are hunting liquidity. They are intentionally causing financial pain to other participants in order to fill their own orders at a better price.
It feels rigged. It feels like the average person just doesn't stand a chance against these machines.
It does feel predatory. But from their perspective, they would argue they provide a service. They provide liquidity when you wanted to panic sell. They were the buyer. They are the buyers of last resort. Is it fair? Maybe not in a moral sense. But is it the reality of a free market? Yes. It's the cost of doing business in the jungle.
You can't be a gazelle and complain that the lion is being mean for hunting you.
Exactly. You just have to learn not to stand in the open field when the lion is hungry. You have to learn not to put your stop losses in the exact same obvious place as everyone else. You have to be smarter than the average prey.
That brings us to our final provocative thought for today.
Smart money buys when there is blood in the streets, even if it is their own.
Wow, that's profound. Say that again.
Smart money buys when there is blood in the streets, even if it is their own.
It means you have to act against your own fear, your own pain. You have to see your own account bleeding and still have the conviction to buy more.
Think about the seismograph from today's earthquake. It was a massive spike. The needle went off the paper. That spike has passed. The big one is over. The question for everyone listening is, can you survive the shake? The aftershocks are still coming.
We survived today, but the volatility isn't over.
Watch the levels we talked about. Avoid the leverage like the plague. And don't get shaken out by the noise.
That's all for this deep dive. We'll be watching those charts with you. Stay safe out there.
And stay liquid.
See you next time.